Welcome everyone to today's plenary discussion. I am really pleased to be joined by three leaders from across different parts of the finance sector to share their insights on how we can allocate funds to deliver sustainable outcomes. Of course, over the last week and more, we've been talking about the different challenges that we face and the role that different parts of the finance community plays in overcoming some of those challenges. And of course, one of the themes that has been coming through those discussions is the need to shift finance away from unsustainable outcomes and be investing in the opportunities that achieving a sustainable future can present. So if I briefly introduce our speakers for today and we can get into the discussion. Firstly, I'd like to welcome Jack Innes, CEO of CalSTRS, one of the US's largest pension funds. Jack, welcome.
Thank you very much. It's good to be here. And again, CalSTRS is the California State Teachers Retirement System. We serve just under 1 million teachers of California. We're a pension fund, obviously, and vitally involved in the issues we're going to talk about today. Our assets are around $272 billion. But I did want to just say that we're going to talk about investment issues here. But for us at CalSTRS, our vision always is in the long term, providing retirement benefits to teachers. And teachers live a long time. We have over 300 teachers now that are over 100 years old. So the alignment of what we're going to talk about here, sustainability, long-term vision, perfectly fits with our constituency and how we think about our core mission at CalSTRS.
Fantastic, and that is a great statistic. Really underlines what it means to be long-term in your thinking.
And our oldest teacher is 108 years old.
Fantastic. Next speaker is Alex Fradel Lopez, the Group Finance Director of Itau Unibank, who can provide the banking perspective. Alex, welcome.
Well, thank you very much for the invitation. I think this panel can be very, very interesting for us to discuss the different perspectives. Itau is the largest financial institution in Latin America. We have retail operations in Chile, Paraguay, Uruguay, Argentina, Colombia, and obviously Brazil. So have over 50 million clients in the region. So from many sides, from the side of our investors, from the side of our clients, and on the side of our activities as a portfolio manager, as bankers, we are very, very keen and very active in the sustainability agenda in this region.
Fantastic, thank you, Alex. And last but definitely not least, Hubert Denso, who is the chair of Africa Investor Group and really straddles some of those different communities, so working closely with sovereign wealth funds and the asset owner community. Hubert, welcome to the panel. Oh, you are on mute at the moment.
Thank you very much, Jessica. And first of all, I'd like to thank His Royal Highness, the Prince of Wales, for this invitation and his, unwavering leadership on this transformational agenda. As you mentioned, for everyone, my name's Hubert Denso. I am the CEO and Chairman of Africa Investor. We're an institutional infrastructure co-investment platform for Africa. Jessica mentioned I straddle a number of different hats, so I also chair the CFA New York's Global Asset Owners Advisory Council, which brings together global institutional investors, pension funds, sovereign wealth funds, endowments, and other family offices. It's my pleasure to be here. I think this is a really important time for us to be looking at the COVID situation, and I think to borrow a phrase from His Royal Highness, this is a reset moment for us as an industry and as a globe and as humanity in itself. And I think that we as asset owners have a very integral role to play because we have a long-term view of life. We have the ability to marshal those skills alongside our capital. So we very much look forward to this conversation. Thank you.
Fantastic. Thank you, Hubert. And I think that leads really well into the first question that I wanted to ask. Now, just as an aside to everyone listening in, please do post your questions as we go along. If there are areas that we talk about that you want to ask follow-ups, the team will be sharing with them as we go, and we'll try and weave it into the conversation rather than lining them all up for the end. So do share as we speak. To get us going, I'd like to pick up on that whole question of the pandemic. Hubert, as you were saying, the Prince of Wales has talked really eloquently about this being a reset moment. And also Ban Ki-moon was talking about the challenges that the pandemic has, of course, had on our ability to achieve the Sustainable Development Goals. But one of the things that we've certainly seen over the last 9 months and more is actually the ESG investment agenda, interest in sustainable investing has really continued to grow and grow rapidly. So kicking off with you, Jack, I'd like to just ask you if you could share your experience. How has your fund's performance been impacted by the pandemic? Has it changed your approach when it comes to ESG and sustainability at all?
Yeah, great. Let me start. And this is my 19th year in this role here as CEO at CalSTRS, and without hesitation, this has been the most challenging year managing this fund. And I never thought I would say that again after 2008 and 9, but in many ways, the dynamics before us, the urgency of what we're talking about today has never weighed harder on all of us that manage pension assets. And even in the recession of 2008-9, as difficult as that was financially for funds, we did learn a lot. And we emerged from that with a much greater understanding of risk management, have made enormous changes in our investment management practices. And that's what you're seeing here too, not just at a pension fund, but across the industry. And I would put if I could broaden your question just a bit, for us at CalSTRS, obviously I'm here in California this morning, and this pandemic, although it's a global issue, it intersects with national and local issues for us in California. We have experienced the worst fire season ever on record for the state of California. And when I say this number to you, it's incredible to say it. We had looking back on the year, we had 10,000 incidences of fire, 10,000. Most of us bought home air filters. We had to change the HVAC on our buildings at CalSTRS to filter smoke coming in the building. Every day we were watching health hazards on the air we were breathing, whether we were in Northern California or Southern California. And then the third issue, which I know we'll get into a little bit later as an opportunity, is our national election. And although that ended for most of us a couple of weeks ago, there's still a few that are still counting votes in their minds. But this change brings a lot of direction that's welcomed on the things we're talking about. So first off, that intersection of the local physical environment of California, our national political framework, which is so weighed on ESG issues, and this global issue have all intersected in how we think about it. But I would say then specifically, it has absolutely sharpened our focus. We've all used this word when looking at the Paris goals and what needs to be done. We all use this word of urgency, move faster, and all those things. But this has certainly underscored that all the more. I would say specifically, there are two things at CalSTRS we have brought more immediate focus to. And that is we, along with a body of investors, actually formed a group focused on what we call the Pandemic Resilient 50, identifying 50 companies that are particularly acutely impacted by the pandemic, whether it's in terms of impact on their employees, the reputational risk of the company, their inadequate disclosures around COVID, dramatic changes in demand for their product. We've tried to identify 50 significant companies in our portfolio along with other investors, and are directing an engagement campaign around this, what we call the Pandemic Resilient 50. So that's one piece immediately that we're working on. And then the second piece is around this weighting, and you see more and more people discussing this around ESG, and that is the S piece itself and human capital and diversity. And I think that's worthy of an hour unto itself, and talking about approaches to diversity. The U.S. has had a very clearly a different path than our European colleagues, and how we have viewed how to make progress in that area. Is it through cajoling, engagement, looking at data, research demonstrating that diversity is important, or is it through a firmer hand? The firmer hand of government or regulatory bodies. So a couple things have happened here. We filed our comments with the SEC back in August, urging them to change the disclosure requirements around human capital, which again, we think specifically connects to this pandemic issue. Our own state of California has passed 2 laws, one last year and one this year, for the first time ever, legislating representation on corporate boards for women, ethnicity, minorities. And NASDAQ now has come forth with a proposal for listing requirements. And if I'd been on this panel a year ago and you'd asked me that, would the US move to a regulatory regime around diversity, I would have been very skeptical. It has never been our approach in this country to really solve problems like that, and not rely on a market mechanism. Well, Europe, as we know, in some countries have been quite firm in advancing this issue now for years. But that also is a turning point I can see going on. And the discussion around diversity is not just a short-term issue. I think, unfortunately for us, what sparked the gravity of that conversation is for some very tragic events. And that has caused us to obviously not just work on policy issues, but all of us that lead organizations in this country have had to talk about racism and issues of inequality within our own organization, with our staff. So this last months have been some tough moments around talking about not just getting better diversity in an organization, but how do we deal with the work cultures and to create more effective. So the impact on ESG, not just around broader climate goals and the things that we know we have to bring us closer to the agreements of Paris. There's also this undercarriage, I think, where there's been a lot of positive development these last months. So hopefully that's kind of shows you kind of our framing of these last months.
No, I think that's really useful, Jack, and it certainly brings to mind some of the things that for anyone who didn't have a chance to listen, last week we had a fireside chat discussion with Melody Hobson, who I think talked very eloquently about the actions that that businesses really need to take. And it really feels like this last year has been a catalyst for a whole series of actions and advances. Alex, coming to you.
I'm sorry, I just want to one sentence you said. I think we all have difficulty judging when there's a movement on an issue. It's just what you said right there, Jessica. We feel it's time. We feel the movement around this issue of racism, diversity, etc. And I do believe that. But we've had so many false starts around some of these social movement issues. And the one in the United States I would flag heavily is around guns. Every time we have a school shooting in this country, there is this enormous reaction. It can't go on. We can't see it again. We have to stop. We have to do this. But I do think around the issues of what's happened this year around race, there is absolutely a significant sentiment going on. And hopefully with the political change that's about to happen in January, we can see movement. Sorry, thanks. I had to say that.
No, I think it's an important challenge, because given the level of uncertainty and change that everyone has lived through, it does feel like there are some of those shifts, but it is very easy to expect it, and then
that's right.
You backtrack. Alex, coming to you next. You're based in Brazil, from the banking perspective, but of course you have strong Latin American but also global footprint. What's your perception?
Well, I think we should never stop learning when we have a crisis like that, and I think that crisis taught us many lessons. And I think one of them is ESG, generally, broadly speaking, is absolutely fundamental for company performance, for company behavior in the long term. And you could see some examples of that. The first one, I would say, how companies how companies are dealing with the S factor, which is their workforce, their clients. Are they doing what is necessary to protect them? And a business with so many employees and so many clients as we do have, this is on our side extremely important, the way that branches would be operating. So we are looking at that element also on the companies that we invest. Another element is to be there for your client. This is very important, especially in the banking industry. So be able to provide to flexibilization of loans, extension, to be able to provide for our clients in this moment of extreme difficulty. So I think we are doing that ourselves and actually looking at for the ability of our companies, the companies that we invest, if they're doing the same. Another important element is governance. So it's not easy to pass through this moment and keep the company working properly. Home office and other elements. Technology is very important. Risk management generally. So this is again is an element that we look very carefully within the bank, and we look at the companies that we invest. Another important view here is your interaction with the community that you are in. So this crisis is very different from the crisis that we had before, because it has a completely different human element. It has a completely different human element. So solidarity, the ability to see you and help other people is extremely important. So it can be through donations, like some companies are doing. We are doing huge donation to that in Brazil, but then looking also at other companies are doing, because we believe that the companies that do well on those factors that I mentioned, they will go better after this crisis has passed, because people will not forget companies that were there for them. Employees will not forget companies that took care of them properly. So I think it's a combination of elements, and many of the elements that are valid for your investments, they are valid for the way you run your own company. So I think they are parallel in that sense. So I would stress those elements that I mentioned.
Yeah, and I think that's a really important point, again, that I think we've seen coming through around that centering in on purpose, what it means to have purpose, as well as that, how that ties to financial value and values more broadly.
If I can give you just Hubert, one example. I'll
let all of you have one response then, as Jack did. Alex, and then Hubert, I'll come to you in a moment. Okay. Alex, yeah.
Just give you one example how people are dealing with their workforce. If they are firing people during this period, they're trying to alternative measures. And this is very important for the people's sake, and this is important for companies as well, because it's obviously very expensive to hire people again in the future. So I think there are many elements, and sorry to stress that again, but I think this is really important.
Yeah, no, absolutely. Hubert.
Oh, no, thank you. Thanks, Jessica. I think, I agree with both of my good esteemed colleagues here. I think it's slightly different for us on the continent because, we've had to tackle a number of pandemics over the years. And as we already know, this is cyclical. So whilst we get our heads around this particular pandemic, we already know for sure that within the next 4 to 6 years, we're going to be experiencing on a cyclical basis another pandemic of one form or another. But I think just having to deal with the current pandemic has given us some good insights in terms of the progress we think that we can make at the policy level as the asset owner community supporting.
No, I think we are losing Hubert slightly there. So whilst the team see if we can
continue regardless.
Hubert,
okay,
are you
wonderful.
back?
Oh, sorry. Yes, sorry. Was it you that lost me? I thought I lost you.
No, I'm afraid you were the one who dropped out, I think. But yeah, please keep going, and we'll bring bring you back if it
Okay,
happens
wonderful.
again.
Okay, wonderful. As I was talking, I think it's highlighted the importance of investing in infrastructure, particularly ICT and telephony-based infrastructure. But I think in terms of the whole ESG agenda and performance, I think as we know, the continent is full of a great deal of opportunity. And ironically, when we start looking at the stats of which take account of the fact that we are sort of 17% of the world's population and only about 4% of the power supply, you can begin to see that as long-term investors and asset owners, that there are genuine opportunities for growth to invest in resilient and climate-friendly infrastructure. But I think one of the points that my good colleagues have also made is that which part of the ESG, of course, it's all important, but for us on the continent, the S is particularly important, and managing the transition for a just and responsible and controlled transition is particularly important because a number of our industries are mining and oil and gas based on the continent. And so we really feel that as the asset owner community, we've had that wake-up call in terms of, yes, we understand these issues, but from a global standpoint, we think it's very important that we as asset owners provide leadership on that, not just on that sort of just transition conversation, and give some practical examples to that, but also recognizing the fact that every time I mention just transition, someone tells me, well, I can introduce you to 5 governors in America that are grappling with exactly the same issue, or Australia or Canada. I think we also like to bring on board as concept of stranded assets. And as asset owners, how can we support policymakers, investors, and all of our sort of key ecosystem? And on the continent, you now have this phrase, I think it's probably global as well, called stakeholder activism, and stakeholder capitalism. And this stakeholder capitalism is something that a lot of portfolio companies and CEOs, heads of funds have really come together with this one mission, and we basically describe it as invest forward better. We really think that our capital is going to be very influential, and being able to take that long-term view, not just trying to get out of this challenge that we're in now, but also anticipating how to build that resilient healthcare, agribusiness, food security related infrastructure, the digital technology that enables us to operate, particularly SMEs to be able to operate in this trade distancing and sort of paperless economy are particularly important themes for us and areas that we can act today. Because the reality on the continent is that our governments don't have the flexibility to mobilize multi-trillion-dollar stimulus packages. So we're being looked to as the investment community and the private sector, recognizing that our response to the recovery is going to have to be private sector and investment led. So, by virtue of the fact of our past experience and the fact that a lot of our funds are already very ESG sensitive and compliant, we're in pretty good stead relative to other parts of the world. But it's no time to relax, you'll appreciate.
Yeah, no, absolutely. And I'd like to pick up on that question that you touched on there of just transition, because I think it brings together some of the different pieces that we've just been talking about and starts to look towards the future and that question of reset. We earlier today had a Q&A with Helen Dean, who's the CEO of Nest, one of the UK pension funds, and they've recently committed to an ambitious net zero target. That's something that we're seeing more and more organisations committing to, and of course governments. It is in many ways particularly hard for those across the investment chain to make and deliver on net zero targets, not least because it involves understanding the footprint of all of the assets that you're invested in or financing, and that forward-looking perspective around what those assets might be contributing to in terms of accelerating progress. But then also, Hubert, as you were touching on there, how do you do that in a way that achieves growth in jobs rather than taking away jobs and leaving communities economically impacted? So Jack, first, I'd like to come to you to share your thoughts on how is CalSTRS thinking about that whole question of net zero and investing in solutions to climate. What different levers do you use? Maybe there's a few examples.
Yeah, and again, I want to go back to where I started today about what we are. We are a trust fund. Obviously, we're accountable to our members, our teachers. We're fiduciaries. So my feedback loop on what we're talking about today and the strategies we do comes back through that membership. And remember, I've got 1 million members, all of which have college degrees, if not advanced degrees, and they read, they think, they hold us accountable. For the last year and a half, every board meeting I've had at CalSTRS, I have protesters. And there are teachers, there are members. They're challenging us on what we are doing and how fast we are moving through these strategies. So we think of all these external pressure points, and I just want to underscore that I have a very strong internal one, which is we're producing pensions for teachers, and they want their money invested responsibly. So that's number one. Number two, the target for these funds is very demanding. In the United States, it's usually about, for us, it's 7%, a little bit more for others, but we use aggressive target returns. And so whatever strategies we're going to discuss here still need to support a 7% return for the fund. And then thirdly, with the doors that are about to open for us on the policy front, I mean, for years and years, policy advocacy has been part of our ESG platform, and we haven't done that well. It's been very difficult. And the most obvious example is setting emission standards in the United States. Although we have a federal standard for automobiles and trucks, etc., California had been given an exception and has set much higher standards for those emissions. And as a result of our environment in California, other states have followed along as well. So we really had the so-called federal standard and then the California standard. The Trump administration challenged that. They have, if they had continued on, they were arguing that California emission standards should not be granted an exception, and the lowering of the standards might well have taken place. So obviously, we're much more optimistic on seeing a regulatory environment that will support aggressive emission standards in the country for what we do. We see hopefully a change in perspectives on regulating methane emissions, one of the obviously most significant pollutants there is, and those regulations had been diluted. We can hopefully have a more serious discussion in this country around carbon pricing and not just state-based schemes that have created this hodgepodge of regulation, and recommitment to the Paris Agreement as well, obviously on the federal side. And then in the specifics of the regulatory environment, I would hope to see the SEC to become finally much more involved in looking at these disclosures that we would like to see. You and I both sit on the Global Reporting Initiative, the GRI board in Amsterdam. And there's so much positive movement there in the disclosure environment, but ultimately it has to intersect with the regulators for sure. If you don't mind, I'd like to call out one engagement that we are supporting that I do think is quite monumental, and that is with the Exxon Corporation. And I think we all recognize that for decades and decades and decades, Exxon has been a mainstay of institutional investor portfolios. It's been a dividend-producing equity for many retirees. It was an essential part of their retirement. But so much has changed, not just in the stock price, but in the management of their capital and their capital allocation, their unwillingness to make serious commitments to net zero emissions, what we're talking about here. Repeated efforts by shareholders to engage with the company unsuccessfully on these issues around disclosure and capital allocation. And interestingly enough, a board of director which if you look at their backgrounds, with stellar backgrounds in business, very accomplished people, but with little energy experience, which is obviously shocking given the footprint of this company. So on Monday of this week, a small investment company in San Francisco, Engine Number One, announced that they would be proposing an alternative slate of directors, 4 directors. But the goal of this outreach is essentially to impose greater long-term capital allocation discipline on the company, create a plan to invest in growth opportunities, renewables, hopefully, and realign management incentives. So I say that to you all because it's an effort by Engine Number One that we admire and support. And for CalSTRS, we have about $300 million right now. That investment has gone down, but we have about $300 million in Exxon, and we'll be voting in support of Engine Number One's initiative in this area. So I took some time with that, but it's an example where it could potentially move the needle significantly around engagement. And if we all share this sense of urgency around what we do, we have to be more aggressive in looking at those tools in our toolbox and not just how we're allocating our own capital to investments. And I can talk more about that later, but I wanted to make sure I get that out there, the need to have a much more activist orientation, I think, in the coming years around our holdings.
I think that's some really interesting points. I think both, yes, how the risk landscape plays an important role playing into this, but also the importance and the other pressures on organisations. So you touched on your beneficiaries. Ontario Teachers is one of our members in Canada, and I think they share a very similar experience in terms of the teachers there in Ontario really pushing and asking questions about what they're doing. But Alex, you're based in Brazil, so I'd like to hear from you from a banking perspective. What is really driving, motivating you to act, and how are you doing that in what at the moment is probably not, it's safe to say, a regulatory environment, a policy environment that is pushing forward this agenda? If anything, it's doing the reverse.
Yes, you're right. But we launched our first ESG fund in 2004. And actually, since 2010, we have internal models for ESG screening of companies that we invest. That goes for bonds and for equity also. So we have evaluating companies on several perspectives. And I would say that over today, we get more than 9% of our investments are in companies that pass through our ESG criteria. But I think as important as that, I believe it's something that was mentioned before. It's we have a strong involvement in the relationship with companies and stakeholders. So through proxy voting, through discussions, we release white papers also trying to, because I still believe that there is some level of education here which is necessary, especially for companies that are getting to the market recently. They are not familiar or or new companies that never been through many crises before. Because if you look at our portfolio, it's consistent with the results that ESG related companies with better ESG performance have better stock returns. So it's a good investment. It is for a reason, because those companies have better governance. They are more prepared to face crises. They are more prepared to face the regulatory challenges. They are more prepared to face other challenges that come into the future. So obviously, the environment in Latin America is very volatile in terms of macroeconomic conditions, sometimes political conditions. And our experience, at least, is that companies that have that really care about those elements, and I include governance here. Governance is really important. Our past experience has shown that those companies perform better also. So I think those two things they come along well. What I mean, it's a focus on fostering companies that have better performance and helping companies that sometimes for one reason or another do not see the value of that. So I think we have a role also That's why we release white papers talking about that and explaining our methodology is explaining our papers available for everybody to see what the criteria that we use and why we use that criteria. And of course, they can apply that. Okay. So I think there is many elements that have to be considered here. Is to select the good investment, is to influence companies, and it's also educating the whole business community about the importance of that. We are a 96-year-old bank. So we've been around for a while. So we've been through many crises, and we really believe in the importance of sustainability from both aspects. So we try also to pass a little bit of that experience to other companies and to see the real importance of that element, not only in speech.
I'd like to follow up with one question around that. Jack gave the example of that direct engagement, that more activist ownership. And I think you are seeing that shift. Definitely still approaches around engaging, supporting, as you've highlighted there, really trying to accelerate the journey that organizations are going on. But where does that stop? So are you starting in the policies that you've put in place just to say, we won't lend to certain sectors or certain types of organizations unless they can demonstrate progression, or starting from a point where there are certain sectors that you might stop investing in, full stop?
Yes, I think there are extreme cases, situations that we do not invest. Say we not invest in this particular company or this particular line of business the way it's being developed. But for example, on the loan portfolio, we have conditional loans that say, well, I'm going to lend you this amount of money, but you not get the full amount unless you address this and that problem, for example. So it comes from all elements. So from not investing to conditionally investing, or try to change governance. So try to improve the governance and through proxy voting, through engagement with other stakeholders. And we also engage with our colleagues also. We just launched this coalition for Amazon, which brings the 3 largest private banks in Brazil. So we are launching this initiative and try to influence our partners and our competitors too, because I think it's obviously Itau is an important bank, but we have strong competition in the region, so I have other banks, and it's important for others to push for that kind of criteria, that kind of solution. Because once most of people start doing this, I think the progress will be faster than if just 1 or 2 players go in that direction.
Can I just ask, do you get pushback either from the government or other people if you identify an industry sector that you say this is not an area we want to finance? Is there
not significantly. We do not, for legal reasons, we do not release names of our clients or specific details about the transactions. But what I can tell you, we've been doing this for a while already. Again, our first ESG only fund is back in 2004. We have those practices for many years, and generally we've been happy with that. So it's been. Of course, some clients may complain about it, may say, well, but this is a more or an individual discussion than a broader one.
And Hubert, I think that point on also collective action is something I'd like to ask you about, and specifically with the hat you mentioned at the beginning of the CFA asset owners work. One of the things that definitely is going to be fundamental, both across all of the SDGs and climate specifically, is the infrastructure investments that are made. And I know that this is something that you've been working on with a coalition of others. So could you share a bit more about some of the insights from that work, some of the challenges that might be thrown up from the insights and the solutions in terms of how you really make sure that investment in infrastructure is sustainable.
Fantastic. No, happy to do that, Jessica. And again, I think that it's quite interesting when you look at the trillions of dollars that are required to meet the SDGs from the infrastructure space. And then you actually look at the number of different sort of initiatives in the market that are sort of focusing on the SDGs. It's quite interesting to note that the majority of the initiatives, if not all, haven't been led by asset owners, or they don't necessarily focus on infrastructure specifically as it relates to sustainable development goals, regardless of the fact that there's such a huge deficit there requiring trillions of private capital. And then of course the issues of ESG, and then when you throw SDGs in there, that needs some stewardship. That needs some kind of coalition approach to be able to simplify the language and start empowering people with the appropriate tools. So at last year's CFA Asset Owners Summit during the Climate Week and during the UN General Assembly, it was quite interesting because in 2018, 50% of the room were fully on board with the ESG agenda. The other 50% were still trying to do the math and wanted more convincing. We came back in 2019 and the entire room of all of the leading and the largest asset owners were completely on board with the ESG and the sustainability agenda. But the key issue that was raised is, there's a data deficit and, the tools that are required to actually measure the impact. And in this case, what kept on coming up is building resilient infrastructure. So therefore, how can you apply ESG to infrastructure and then take account of the sustainable development goals, in relation to reporting and measuring impact in particular? So I convened and chaired the CFA's response, which was basically to lead an industry-wide approach. We built quite a useful coalition from the CFA Asset Owners Council, Long-Term Infrastructure Investors Association, UNPRI, International Federation of Sovereign Wealth Funds, and a number of other GRESB, SASB. I mean, a lot of the sort of key leaders in that space. And we launched a framework during this year's World Bank annual meetings with the World Bank Group Treasurer and head of their pension fund, Jingdong Hua. And the framework essentially has a total of about 215 contribution types to the Sustainable Development Goals. So in effect, an asset can have a maximum of 114 positive contribution statements to the SDGs and say 78 or so opportunities to make a contribution. And then it's also got a number of different negative contribution facets to it as well, about 23. But the data types from the framework have been taken up quite rapidly. And they're already being used to report on a number of infrastructure assets. GRESB, who are one of our partners, have already applied the framework to about 425 infrastructure assets. So the framework provides basically a means to identify both risks and opportunities in relation to the SDGs, including greenhouse gas emissions. So when you're looking at reporting on greenhouse gas emissions, these are really addressed under SDG 9 and SDG 13 of our framework in particular. And there's also another important data point that we had to sort of really focus on and ensure that was covered, which is the spirit of why we're here today, which is obviously net zero. The greenhouse gas emission intensities and year-on-year performance of assets in that domain is something that we really had to spend a lot of time, consulting and getting different analysis and input on that. So if, for instance, the greenhouse gas intensity of an asset increases year on year, then for us, it's considered as a negative contribution. But for completeness sake, we then had to review and add an additional 13-point-X target, which is to move towards a climate neutral economy and implement commitments under the Paris Agreement. So that really sort of captures the relevant climate change mitigation contributions under SDG 13. So we sort of see this whole initiative as it's a public good, and it's available on the CFA's website. And one of the interesting things that we, were cautioned and we learned from this is that a lot of the frameworks and approaches are appropriately sophisticated in nature, because obviously there are a lot of complex issues and details that one has to take account of. But we also have to remember that we've got trustees and other board members that are involved in the investment decision making process that need access to these types of tools as well, that may not have that level of investment professional training, if you like. So we actually try to ensure that the user guide can really be something that's relevant and valuable to boards of trustees. Could be teachers with no investment training or experience, and also to key investment staff and consultants. So, I think one of the things that we learned from this is simplicity, and then not to presume that because there are a number of different initiatives in the market that sort of carry the SDG tag, that the actual underlying problems have actually been addressed. That's why we actually just focused on real assets and the catalytic nature that infrastructure will have on building the essential resiliency, and then the role that asset owners can play. So that's our approach to that. And going forward, we are really trying to understand how to modernize our thinking as the market has already with the notion of infratech. So we actually see this as the data itself being infrastructure, and it has many different uses in its modular, formation that can assist, different key stakeholders. So we are really seeing the importance of data, and in that respect, we're going to be working very closely with the multilateral development banks. This is, as an asset owner-led initiative, bringing on board all of the other key stakeholders to be able to find ways to use the likes of the blockchain, artificial intelligence, deep learning, to be able to create more innovative access to the data, and more almost commoditized access and availability for this agenda going forward. So I'll stop there.
Yeah, I do think that's a really important point. We saw on Friday's discussion last week some examples of the ways that technology is being brought to bear to provide and close those data gaps. Now we've got about 15 minutes, just under, for the discussion. So what I would like to do is come back to some of the questions we've been having from the audience. And I won't necessarily ask all of you to answer each one. So let's see if we can get through a couple of these. A place to start, which could easily take the rest of the conversation, so I will ask you just to give one or two thoughts. On Friday, we're focusing the whole day on that reporting agenda, which is one part of the answer in terms of closing those data gaps. And Jack, you mentioned you're on GRI's board. Alex, you're on the A4S Foundation board, which is obviously doing a consultation at the moment. And we have GRI CEO, SASB, GRI's chair, SASB CEO, and another of your fellow trustees on the A4S Foundation, all speaking on Friday. So we'll have an opportunity to get into detail then. But from each of you, I'd like to hear from your investor hat, do you think some of the movements that are happening in that standard setters world can help to close the gaps that you need to drive your investments towards sustainable outcomes? So Alex, if I come to you first, and then Jack very briefly, and then we'll come to the next question.
Sure.
Well, I definitely hope so, because I think this consultation paper is especially three questions. The first one is, do we have a problem? Lack of comparable data, lack of consistent standards. The second one, is the A4S Foundation the right body to solve it, to address it? And the third one is how to. At least from my perspective of talking to people, no one disagrees with the first one. So we do have an issue here. So data is not comparable, too many standards. It's very hard from a preparer's perspective, I can tell you that, to be compliant with all of them, because they are just different notions, different frameworks. So I really think we do have an issue in this, and especially as the data is not generally assured. When you don't have assurance, you don't have comparability. So I certainly do hope that this initiative that we are on the consulting at the moment is an important step in that direction. I think you've been to the SASB meeting last week. Also, that discussion came along as well. So I really do think this is one way. Of course, I'm a trustee, so I'm biased to say because I'm a big supporter of that proposal. But I think it's an important step. If you have coherent standards, then you can have assurance. Then we can have comparable numbers and comparable metrics. Okay.
Jack, so how would you see GRI's work playing into that?
Well, I think we need to remind ourselves, even though we're having a good investor conversation here today, the conversation around ESG is a multi-stakeholder conversation and involves many audiences with different needs of data and information. So as we gravitate toward better solutions, all of those interests have to be entertained, not just a financial materiality or a narrow definition that maybe investors have had some focus on initially. And also, let's remember how many years we have taken to get financial reporting right. I mean, in excruciating detail and boards and work and everything that goes into financial reporting. And now we're arguing that ESG information has as much value in our investment decision making. So this has a road to go. There's no doubt about it. But the word you just used, assurance, for an investor is absolutely part and parcel of the solution. We have to end up with a scheme, whether it's a governmental scheme or a not-for-profit scheme, that brings in assurance into the solution. But again, I think the power of GRI has always been on that broader view, that multi-stakeholder view, that really where ESG is founded upon.
And as we touched on at the beginning of the conversation, the two are very closely connected and increasingly closely so in the world that we're living in. So
and it's we worked so hard to get regulators to pay attention to this, and we have that interest. We have the part of the SEC, we have the Federal Reserve in the United States writing white papers. We have the opportunity here. Yeah.
One of the other things that has come up a lot, and there's a question around this, is around skills and skills gaps. Hubert, you were touching on that to a degree in terms of some who have that financial experience, but not necessarily the sustainability, and vice versa. There's a broad set of issues that we're dealing with and talking about here, and growing demand for sustainable investment and sustainable investment products, but a pretty huge skills gap in terms of people who really understand both of those areas. So I'd love to hear from any one of you, any thoughts on how do we close that skills gap and really accelerate the knowledge and understanding that is needed.
Yeah, I don't have too much to say on that, besides the fact that one of the important things that we've seen in this space is really to create a culture of data and generating data. Because as Jack mentioned, there's a lot of different players all coming at this from their own view. But I think if we try to just fit in with everyone else's, we miss an opportunity to generate a lot of rich data. And of course, we know that's the way that and the direction that the world is going. And I think we recognize there is a deficit in terms of skills, and I think that that there needs to be some self-reflection from us as investors in terms of the nature and the quality and the consistency and the availability of the types of education that we think we will need for this data-driven ESG climate sensitive world that we're going to be living in. So that's why at the CFA obviously there's lots of different training programs, but they are evolving, each and every day. And we hope that the more we can generate more data, the more we can innovate these types of programs and opportunities to upskill, right skill, just share the knowledge so that, we're hearing from the trustees. We want to understand more about how we can factor this into our decisions. We want to be able to check some of our consultants, because maybe some of our fund plans are so small, we don't have the domain expertise and knowledge. So we're seeing the demand. I think the question really is, how can we intermediate that demand? But I think recognizing that it's a real need, and clearly we know that the performance of ESG and the reality of the need to be focusing on long-term resilient investments going forward just means that we just have to solve that problem. And I think organizations like your own and a number of the other ecosystem players, I think, are very well placed to do that.
So one of the other questions that we've had a few versions of is coming back to that question of financial returns and sustainable outcomes, and whether you all feel that that connection is proven. So is the evidence there? I think, Alex, you touched on that from your experience, absolutely. Or actually, are we at the stage where if you look ahead, look at some of the risks, we know, at least from that macro perspective, but for many individual investments as well, these issues are going to have such a massive financial impact that actually we need to start making decisions on that broader, I think people have talked about it as setting ambitious targets and then just setting out to deliver on them, and then looking at the returns in that context. So I don't know if anyone has any additional thoughts to make on that. Alex, maybe I can pick on you first. You were saying that in your experience, it's a false split to be thinking of things that way.
Yeah, I can tell about my our experience, and there is some body of academic literature as well. In one of our white papers, we have some other studies made by other investors or analysts, and for the best of my knowledge, of course, I think this is a developing area. I think evidence is being accumulated so far. I think my view is that the evidence suggests, being very cautious here, the evidence suggests that there is a relationship between ESG and better return. If you consider a proper time frame. Of course, this is not something that you have to eliminate a lot of noise from the data and look at the long-term performance, which doesn't surprise me significantly, because if you are defining ESG well, sustainability practices well, I would expect them to be correlated with long-term future performance on average. So this doesn't surprise me that much, at least the way I see ESG and I see those important practices.
All right, thank you, Alex. And we are close to the end of time, so I'm going to ask each of you to share your final recommendation, the final action that you would like to leave everyone listening and watching today with. I will come to you first, Jack, and then Alex and Hubert, you will have the last word. So very quickly, your headline takeaway message.
My headline is, we all agree there's a sense of urgency, and we have some success going on in terms of all these initiatives, pledges, all the activity going on around us. But our risk now is a bit a victim of our success. Do we have the right focus? Do we have the right priority to what we do? We've got some significant regional differences around SDGs and how we approach index funds and all the variety of investment strategies. But we've got to figure out what can be that core set of priorities that can get us to where we need to be for the Paris Agreement. And that is worrisome. We must come together around those and not let all these pieces distract us.
Well, I clearly subscribe to his point of view, and I would just add that, again, we should not waste the opportunity to learn from this crisis, and opportunity to learn from the risks we can face. We mentioned many of them here today, but this pandemic is really unique in that perspective, and I think we can learn a lot about the importance of ESG from what we are seeing around the world.
Hubert.
Great. And then I think I would, again, as ever, just agree with my colleagues there. I think that the one focus area for us is really just how to facilitate more partnerships across the ecosystem as asset owners. I think in some respects, other players within the ecosystem, the broader ecosystem, have many years on us in terms of getting access to data, familiarizing themselves with the issues. So I would say within the whole partnerships and the ecosystem partnership area, I think one that I've already talked about, we should be intently focused on data-related partnerships. And I think we're quite thin in that respect. We should create that culture of how we can generate and use and make that our contribution as the asset owner community. So ecosystem-led data partnerships, particularly with development finance institutions and multilateral development banks who have some supportive and data that could help us really provide some leadership in this particular area. And then secondly, which is a practice that we're beginning to see across our own investor ecosystem, which is climate-friendly co-investment partnerships. And that's essentially done on a network basis between global asset owner networks. And the focus there is much more to systematically originate and facilitate investable climate-friendly opportunities and transactions. And I think there's a lot of cross-fertilization and knowledge and training through some of these different approaches that globally, as an asset owner community, we can all learn from each other, share with each other. I think Jack mentioned he's talking about a 7% hurdle and targets that he's got to meet. And if you look at infrastructure just on the continent, as I mentioned before, on average, we are looking at mid-teen returns, early 20s, but yet we don't have that big pipeline of climate-friendly transactions. So maybe working with other institutions that can bring that expertise, we can create that situation where we can, really invest forward better and meet our targets and make the world a better place.
Fantastic. Well, I think that was really interesting, diverse set of views, but actually underneath it, a huge amount of consensus in terms of the actions we need to take and how we can work together to achieve them. I would just like to leave everyone with a few words about the next couple of days. So tomorrow, the focus is on measuring what matters. We'll be picking up some of these strands, sharing and launching guides that the Canadian chapter of our CFO Leadership Network has worked on around how do you embed climate into valuations. And also some of the work we've been doing with our asset owners network, looking at the launch of a pensions toolkit. And then on Friday, as we've mentioned, the focus is on reporting. We'll be speaking to all of the main framework providers and standard setters. So do have a look at the full day of events, join the webinars, get your questions answered. Thank you again to our panelists, and we'll look forward to speaking soon. Thank you all.